We figured out that we could do an ATM. And so we could sell the stock. We could sell $1 of stock backed by 30 cents of Bitcoin, buy back $1 of Bitcoin, capture a 70% spread. And so we got to the point where we're doing it 10 million a day, then 20 million a day, then sometimes 500 million a day. We got pretty good at it. And we did a few billion of it. We made $1 billion doing that. And then in October 30th of 2024, we had to renew that ATM shelf registration. It was a week before the elections, and we decided, well, what the heck? 21 is a magic number for Bitcoin, so we're going to file a $21 billion shelf registration to sell $21 billion of equity. No one had ever done that in the history of the world, but no one ever had a use of proceeds. And at this point, our shareholders trusted us, and they knew that every single time we did a transaction, it made them money. Right? If you want Bitcoin and I buy the Bitcoin and I sell the stock at a premium to underlying Bitcoin, you just made money risk-free, you see. And so the BTC yield shows you that that was an accretive transaction. You got more Bitcoin per share. And so we came up with a way to do a high-speed accretive transaction. We could literally do it the same day, right? So it's like, I do $1 billion, I raise $1 billion, I develop $1 billion of real estate, I fully lease it out, I can show you I made money on it, I put that news on the wire, I go back next week, I raise another $1 billion. Mm-hmm. Imagine if you could just do that with no risk every single week, right? You're running 1,000 times faster than the real estate business. And the message was, we're only going to sell the equity if it's accretive to the shareholders. Well, if you were a conventional company and you did that, the stock would crash because people would think that's dilutive.
Dilutive, yeah.
But if people believe that I'm going to use the capital to make the money, it's accretive. Mm-hmm. And that just comes down to trust in the management team, right? And alignment. Do your shareholders expect, it's just like whenever you raise money, if they thought that you were going to lose the money that they gave you, they wouldn't give you the money.
That's right.
And if they thought you were going to make money for them that was more than their hurdle rate, risk adjusted, they would give you the money.
Yeah.
It's just a basic matter of, do I trust the management team to be a good custodian of my capital? So we got to the point where we've been doing it for a year. So we announced a $21 billion shelf registration. The stock trades up.
Were you surprised?
The next day. No, I wasn't.
A little surprised?
Other people were, but I wasn't.
Were you happy, elated?
Look, I'm the guy that built the bridge, and I'm like, it's a steel bridge. We're going to drive a truck over the bridge. It'll be fine. Everybody else thinks we've never done that before. The bridge is going to collapse.
Right.
You know, Howard Hughes flew his own airplanes.
Yeah.
You know, so I'm just the guy that thinks I built the machine. I think the machine is going to work. And so, you know, if I waited for skeptical people to believe the machine was going to work, there would be no machines in the world, right? Yeah. Nothing would be done. Ever, right?
Right.
The great irony is that, you know, in 1902, every learned aeronautical engineering professor was sure we'd never fly. Mm-hmm. And the guys that went flying were the Wright brothers. They were bicycle mechanics that without a degree. It's like sometimes you need the guy that's just going to do it that doesn't know why it can't be done because other people, you know, just engage in some mental gymnastics to convince themselves that their lack of courage is totally justifiable and it's okay for them to not do anything. We file the registration, the stock trades up. We start selling the equity. When we're doing that, we're selling $3 of stock backed by $1 of Bitcoin. We're buying back $3 of Bitcoin. We're basically selling dollar bills for $3. Bitcoin's 55,000 in September. It's maybe 68,000 the beginning of November. And then all of a sudden he wins, and it runs from 68,000 to 106,000 in like 5 weeks. Okay, this is the raging, you know, crypto wave. And we started selling 500 million of equity a day. And we're making 300 million a day on the trade.
300 million.
And then we have $1 billion day. And I think one day we had a $2 billion day.
This is more cash than you had 5 years ago.
So we blow through we thought it would take us 3 years. We might actually get through the equity. We go through the entire $21 billion program in weeks.
Oh my God.
And so it's the largest issuance of equity in the history of the world. And when we sell the 21 billion of equity, we make like $13 billion in gains on the Bitcoin just in the round trip. So we generated $13 billion just by exploiting that ATM. And that's because all the equity capital markets investors, they wanted exposure to Bitcoin. Between the people buying the equity and the people buying the derivatives and all the leverage that came in, there's just a wall of money comes. And so I don't know, we raised more than $20 billion
This year.
In 2024.
Okay.
In 2024, we raised more than $20 billion. And then we roll into 2025. And now we get to the point in the story where you're like, well, when did you realize you're leading an industry or a movement? Well, it's kind of like in 2025, because in 2025, we renewed the $21 billion program. We had maxed out the convertible bond industry. We basically we became the biggest issuer of converts. And we started thinking, not how are we going to sell the next 5 or 10 billion, how are we going to raise the next 10 billion? The issue is, how do you raise the next 100 billion? How do you raise the next 200 billion? How do you become $1 trillion company?
Damn.
And at that point, I took everything I'd learned, right? And you know, you kind of have to build it the first time to build it the second time and break it so you can build it the right way the third time. You know, the iPhone 3 was the win.
Yeah.
You know, it just takes, the jet engine you're in right now is not the first version, right?
That's right.
So we get to 2025 and we started thinking, you know, what do we really want to be when we grow up? And we realized, you know, convertible bonds are a nice trick and selling equity at a premium is a nice thing to do. But ultimately, you're not going to be a multi-trillion-dollar company by doing that. What is the thing that the world needs? And what do we need? Well, what we need to do is we need to be able to sell $100 billion of credit instruments that create amplification for the equity. And we need to do it without credit risk. So how do you actually raise $100 billion and take no credit risk? So we don't want junk bonds. We tried bank credit with Silvergate. The bank failed. We tried senior notes, you know, and that was it was like a yoke around our neck. We had too many covenants and EBITDA covenants and the like, so that didn't work. And then we tried convertible bonds, and we did 10 billion, and they were successful. But you know, at the end of the day, they weren't going to scale
Because
they trade over the counter. You know, it's illegal for a retail investor to buy one.
Jeez.
You know, back to all these securities laws, they're 144A issues. So that means you have to have $100 million of capital, being a qualified institutional buyer, and they trade over the counter. And over the counter is it's a polite way, it's a euphemism for, you know, 32 dudes trade with each other with one broker in the middle. You know, it's like a
Diddy party to me.
It's like a bunch of guys meet in the back alley,
weird
in the
to me.
corner, and they all trade with each other in the back alley, and there's a bid-ask spread, and there's no trades for the last 18 days, and you can't get the bid quote or the bid-ask quote. You have to pay $25,000 a year for a Bloomberg just to know what the last trade was. You know, it's too difficult. And so what we discovered is they were illiquid instruments, but maybe more importantly, what we realized is they were literally investment grade, like they're 50x over collateralized. So imagine a bond where you've got $50 of capital for every dollar in the bond, and it trades like triple distressed debt going out of business. The credit spreads were like it was a triple junk bond going out of business, but the backing collateral was triple investment grade. And so if someone said to you, I want to be 50x over collateralized and I want you to pay me 20% interest, you're like, that doesn't seem quite right.
Right.
And so we just realized it wasn't good for the issuer. It wasn't even good for the buyers. It only makes sense for the convertible arbitrageurs, but the convertible arbitrageurs, they're not long Bitcoin. They don't want to invest in Bitcoin. They don't want to invest in the company. They're not really even credit investors. They're traders. And so we started thinking that we needed to fix the credit. And so we basically traversed from bank credit, asset-backed loans, senior credit, convertible bonds. And we started thinking, why don't we sell preferred stock? And preferred stock is like a bond, but it's perpetual. So I sell you $100 million of
Perpetual
preferreds. means it never comes due. I'm going to borrow $100 million. I'm going to pay you 10% dividend a year forever. I'm never going to pay you back the principal. It's equity. And I approve the dividends. If the company can pay the dividend without being insolvent, then the company pays the dividend. But the board is not allowed to pay the dividend if it would render the company insolvent. So you see, if you sell a preferred equity instrument, by definition, there's no credit risk. You can never be in default. You see? If you structure it right, you're not paying back.
Because it's first in line?
You're not paying back the principal ever.
Okay.
How do you default on that?
Right.
You're not paying it back. And the dividend is not a coupon. You can't be in default. You can be in default if you don't pay the coupon on a bond, but on an equity, if you skip the dividend, you know, you might have an obligation to accumulate the dividend and eventually pay it, but see, you're not in default. You see. Not in the same way that you'd be in default on senior debt.
Right.
You know, in senior debt, you pledge collateral, you miss the dividend.
Has this been done before?
People have, preferred stock have been around forever.
Okay.
Yeah, I mean, I didn't invent preferred stock. It's just I invented the idea of putting preferred stock together with digital capital. You know, I would say we went from desperation and frustration to being opportunistic, you know, and tactical, and then it was really in 2025 that we really became transformed into a new business. Because
what was the funnest stage of those three?
Oh, now it's the funnest.
Oh, it is?
Yeah, because now we invented a new business.
Right.
And let me describe the business.
Please.
It's digital credit. Basically, we created a new asset class, digital credit, backed by Bitcoin, which is digital capital. And we created a new business model, digital treasury. So we're a treasury company. We sell securities, we buy capital, and then we create credit instruments. We sell the credit. And the credit, digital credit, is 100x better than conventional credit. Because first of all, it's built on top of appreciating collateral. Bitcoin's going up 30% a year. It's not on depreciating collateral. When you create credit on a warehouse or you create credit on an iPhone 17, these products and services and buildings are, you know, the Rockefeller Center has got a 40-year, 50-year life before you got to do a full rehab, right? Renovation. So you've got appreciating collateral, not depreciating collateral. Then
because
the second,
Bitcoin.
Because it's digital capital, because it's Bitcoin. Because Bitcoin is good for, remember when I told you it's like useful life is immortal?
Right.
What, you know, would you like to build, what if I gave you a building that was maintenance-free, tax-free forever and never rusted?
Please, quit talking like that.
It would change the economics of real estate, right?
Everything.
Okay, so that's kind of what we did. We built it on a digital building. Okay, so that was the fundamental. The second thing we did is we created the credit as an equity instrument, not a debt instrument. That means it's an asset on the balance sheet. It's not a liability. Okay. The third thing is we made it perpetual equity. There's no call provision. There's no refinance provision, which means that the people that bought the instrument can't call it back or redeem it. For example, when you're a bank, if I put $1 billion in your bank, you've got the capital, but next Tuesday I can actually withdraw my money. And so you've got the money for 2 days. Bank deposits are temporary capital. If I gave you $1 billion and you gave me a 5-year note, a corporate bond, you've got the money for 5 years, but in 5 years I get it back.
Right.
If I gave you the $1 billion in a preferred that was perpetual, you've got the money forever. I'm not getting it back. So we created a perpetual credit instrument, not just a temporary credit instrument. That's the third innovation.
Okay.
The fourth innovation is that all of the credit was based upon that digital capital, so it's all transparent, homogeneous, real time. You can recalculate the credit risk every 15 seconds. Well, you know we're 10x over collateralized on Bitcoin. You plug in the price of Bitcoin, the volatility of Bitcoin, your forecast of Bitcoin. It spits out statistically what is the risk of being under collateralized over the term of the instrument. So that's the third thing. And then we took it public. So we made it public credit, not private credit, which means that there's a ticker, STRK. STRC. It's got a name. You can buy this on Robinhood.